Nokia OYJ/KEL/NOK is currently closed for standard trading in Helsinki at 8.452 euros per share, reflecting a daily decline of 2.16% following a volatile stretch of market sessions. On the New York Stock Exchange, Nokia ADRs last closed at $9.58, down 3.43% on the day, before edging up slightly to $9.59 in extended after-hours trading. Most investors still look at Nokia through the rear-view mirror, viewing it as a legacy telecom hardware maker or a forgotten smartphone giant that missed its turn decades ago. The market consensus treats this stock as a low-margin, slow-growth infrastructure play tethered to the capital expenditure cycles of cash-strapped telecom carriers. But if you peel back the layers of recent trading activity and order flow, a fundamentally different reality emerges. While retail traders were watching standard 5G rollout updates, institutional volume silently flooded into Nokia as a critical back-end AI data center hardware play. Credit rating upgrades from S&P Global recently flagged a positive outlook precisely because Nokia is quietly diversifying away from traditional telecom operators and aggressively capturing high-margin enterprise AI infrastructure demand. The Street expects a tired telecommunications vendor, but the underlying numbers hint at an optical networking and private wireless engine riding the massive expansion of artificial intelligence compute centers. When you analyze the immediate stock movement over the past few trading sessions, the tension between Wall Street's expectation and this underlying reality becomes striking. Nokia experienced a sharp intraday rally after reporting second-quarter earnings that beat EPS expectations, coming in at 0.07 euros against the 0.06 euros consensus estimate. Yet despite beating on profitability, top-line revenue landed slightly short at 4.82 billion euros against the expected 4.83 billion euros. That modest revenue miss triggered a knee-jerk algorithmic sell-off, knocking the stock down to its current 8.452 euros baseline. But look closer at where that money went. Institutional investors capitalized on the temporary dip, absorbing millions of shares near technical support levels. High-frequency trading volumes surged well past average daily limits as smart money recognized that Nokia's margin expansion was driven by its highest value segments, specifically Nokia Technologies, its high-margin IP licensing arm, and its optical transport division. This daily volatility highlights why modern traders cannot evaluate a company based on headline revenue alone. Whether you are using a Robinhood stock trading setup for rapid execution, utilizing a SoFi active investing account to build a balanced portfolio, or executing complex strategies on an interactive brokers platform, understanding these internal margin shifts is crucial. When analyzing active listings across mainstream investment platforms like Fidelity or evaluating options flow on an individual brokerage, the disconnect between top-line headlines and underlying earnings power often creates the richest trading opportunities. Comment below how many shares of Nokia stock you currently hold in your portfolio and whether you are buying this recent market pullback. To fully grasp why this tension exists, we have to examine the operational core of Nokia Oyj. Headquartered in Espoo, Finland, Nokia operates through four main business units: network infrastructure, mobile networks, cloud and network services, and Nokia Technologies. For years, the Mobile Networks division, which supplies radio access network gear like cell towers and 5G base stations, was considered the flagship. That was the division that trapped investor expectations in a low-growth cycle as global telecom carriers dialed back 5G capital expenditures after the initial build-out wave. However, the real driver today is network infrastructure. This segment manufactures the ultra-high-speed optical routers, subsea cables, and fixed network technologies that connect modern cloud data centers. When hyperscalers build massive clusters of graphic processing units for artificial intelligence models, they require unprecedented data throughput and zero-latency routing. Nokia's optical switching technology directly solves this physical bandwidth bottleneck. Furthermore, Nokia Technologies generates pure cash flow by licensing its massive patent portfolio, spanning basic cellular protocols to advanced video compression to consumer electronics manufacturers, automotive companies, and IoT developers worldwide. Past financial performance reflects a company mid-transformation. A few years ago, Nokia struggled with heavy operational bloat and intense price competition from competitors. Management responded by initiating an aggressive restructuring program, stripping out billions in structural costs, trimming headcount, and reallocating capital straight into research and development. This structural pivot allowed Nokia to maintain gross margins near 40% despite macro headwinds, high inflation, and stagnant overall capital spending in the broader telecom sector. Looking ahead, the future outlook for Nokia stock hinges on several key catalysts and clear risk executions. On the bullish side, the accelerating adoption of private 5G networks across industrial campuses, defense sectors, and smart ports presents a multi-billion-dollar enterprise runway that operates entirely outside of traditional consumer telecom budgets. Furthermore, if interest rates ease globally, regional carriers that postponed network upgrades will likely be forced to resume ordering to keep pace with skyrocketing mobile data consumption. Conversely, the primary risk remains capital concentration. If enterprise AI infrastructure spending slows down, or if major cloud providers delay their optical network upgrades, Nokia's short-term growth trajectory will take a direct hit. In summary, the market narrative around Nokia OYJ remains anchored to an outdated perception of a legacy hardware vendor struggling against carrier spending cuts. The reality on the ground, and reflected in the intraday trading dynamics, earnings beats, and institutional accumulation, is a higher-margin, restructured technology company positioned right at the heart of global data center expansion and intellectual property monetization. As expectations gradually align with this operational reality, Nokia presents one of the most compelling risk-reward setups in the broader technology and telecommunications sector. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.